love the channel and find it useful in becoming a happy retiree. Subscribe today. Kate joins us on the line. Kate from Kennesaw. What's going on, Kate?
Hi, Wes. I've recently learned about an investment in insurance where you can invest up to $250,000. You earn supposedly 1 to 9% a year. There's no penalty. You can pull it out whenever you want to. And there's a death benefit and a long-term care benefit. And I know most of these type policies, there's a penalty or you can't touch them for 10 years. And this just seems like it's too good to be true. Do you know about this?
It does. So again, the parameters are that it's some sort of annuity. Is that correct? Or insurance product?
Mm-hmm. It's a life insurance annuity.
Got it. And you are going to put money in this and you're at least going to get 1% up to 9%?
Correct.
Well, a couple of thoughts here. First of all, so when what sounds too good to be true to you?
Well, that you can pull your money out at any time, and that you're guaranteed this 1 to 9%, and there's no penalty for moving it out. I don't know. It just seems like there would be some kind of risk, like most have, where you have to take a penalty if you take it out early.
Well, so what Kate is referring to here is typically, these are typically called equity index annuities. And equity index annuities are an insurance-based product that says they're tied to some sort of stock market benchmark. That's how you get the upper end of that range, right, Kate?
Yes.
You've got the 1% all the way up to 9%, which starts to pique your interest. You're like, whoa, what? Zero downside, but up to 9? That sounds pretty awesome, right?
Right.
And usually there's the one of the bigger catches, the gotchas, are that you have to hold the money in there for 7, 8, 9, 10 years. And if you don't, you take a big penalty to get out. So it's almost like you're placing handcuffs on yourself in order to invest money. And that's what buying into one of these products means. What's interesting, one of the things you said here, and all the parameters seem pretty similar to other equity index annuities that I have heard of, but you had said something about the $250,000 range. What was that?
That was the cap you can invest.
So they'll only let you do up to $250,000.
Correct.
I think that's a great new marketing tactic for them. That it's saying, well, you can only put $250,000 in this. It's so special. And it's such a prized investment that you can only do $250,000. Beyond that, that's all you can do. But if your husband wants to do another $250,000, he can do $250,000, and your kids can do $250,000, and anybody in your neighborhood can do $250,000. So really, Kate, that's just a marketing ploy that one of these insurance companies are going to do. So here's this is just like every other one of these. The catch here is the marketing sizzle that they're giving you. So 9%, by the way, is about what the S&P 500 has done over the course of history. It's actually closer to 10% over the course of history, 10%. So most of these annuities, in one way or another, tie your investments, at least on the surface, to no downside, but you could get a portion of the market. Now, I have seen hundreds of these index annuities, Kate, over the course of 20 years. And I've never, in the course of all these years, seen an index annuity do any better than about 3% a year on average. And that's on the high side. And yet they're tied to the S&P 500. They're tied to, or at least the formula is tied to, because remember, they're not actually investing in the S&P 500. They're not actually investing in the NASDAQ. They're not investing in stocks at all. They have a formula that one of the inputs in the formula is whatever the index did in that given month, Kate. So they give you the optics that say, oh, it's tied to the market, so we're going to give you some of the upside of the market. And you say, well, on average, the market's up 10%. I'll take even half of that. Sounds great to me with no downside. But that's where the too good to be true comes in, Kate. And that's why that even you could tie this thing to, and I used to use the example of, do you remember when there was a toll road on 400? Do you remember that?
Yep.
I remember it because so many years I drove through that toll road, and I thought to myself, these index annuity companies could tie your investment returns to the number of cars that made it through the toll on 400. It doesn't matter what the metric is because they don't invest in the S&P 500. They just they use that as a number that they can now take a percentage of. The percentage could be 0.1% of whatever the index does. It could be 0.2% of whatever the index does in a given month. You could tie it to the number of oranges on an orange tree in a given year, because it doesn't matter what the number is, because formulaically you could always say, oh, well, I'm going to take this number, which should be around X, 10 or 100 or 1,000, and then apply a 0.1% to it or a 0.001% to it and make that your formula. But you, on the other hand, think, wow, there are 1 million cars that go through that toll every week. I could get some portion of 1,000,000%. That sounds like a great deal. Or I can get 10% in the S&P 500 and I'm going to get a portion. That sounds good. In the end, Kate, the formula never gets you there. And again, I guess I can't say never because there's no nevers here, but the vast, vast, vast majority of the time, let's call it the vast majority of the time, what you end up getting in these is about, at best, about what Treasury bonds do. At best, about what Treasury bonds do. And today, if you think about it, a 1-year Treasury bond gives you 2%, and you've got no risk of the insurance company that you're going to buy this product through either going out of business, number one, or them changing the rules on you. And I have seen that happen many times. That's the other catch, Kate, is that these companies can sell you an annuity, and then 5 years down the line, they can change the formula, they can change the process, they can do whatever they want to do because it's not an investment, it's an insurance product. So there is a lot wrong with these things. They make it seem like it's too good to be true on the surface. What I have seen in the real world, I've never seen these things go beyond about 3%. Many of them, by the way, Kate, I've seen get closer to 0.5% a year, maybe 1% a year. So and that's fine because it is a conservative investment. There's a low probability that these companies go out of business, right? And it's great that a lot of these things for most investors, part of the biggest mistakes a lot of investors make is they're hopping in and out of the S&P 500, then the international market, then bonds, and they ultimately have poor returns because they do that. These products almost force you to stay invested for these long periods of time. Now, in your case, you're saying, hey, this one doesn't say I have to leave my money in at any period of time. You can put $100,000 up to $250,000. That's so nice of them to do. And then you could pull it out the next day. That's correct?
Right.
Okay. But remember, what are they going to invest the money in? They're not investing it in stocks. They're probably buying bonds. And right now, bonds are paying 1%, even for short-term bonds. So I don't rail against these products without giving you something else to do. I think if you really want safety and something that's not going to go out of business anytime soon, you look at U.S. Treasury bonds. That's really that's the ultimate risk-free rate in America, not some big insurance company. Remember what happened to AIG. Remember what happened to big insurance companies.
Concern.
Yeah, exactly. Remember, these are companies making you a guarantee. A company making you a guarantee really doesn't mean anything because the company can go out of business. Toys R Us just went out of business this week. They were the de facto default mega leader in a massive billion-dollar industry, and they started to lose ground once Amazon came into play, and they are out of business. If you owned a Toys R Us bond, it'd be worth pretty much zero today. If you owned their stock, it'd be pretty much zero today. So there is no such thing as a guarantee when it's coming from a company. There's only a guarantee when you're buying a U.S. United States government treasury bond. That's the only thing. And that in itself, Kate, can get a little bit scary as our national debt goes to the $20 trillion mark. So there's no such thing as risk-free. I would say that the last thing that I would want to do is put money into some insurance product that's guaranteeing me all these things. In reality, I'm probably going to get 1 or 2% a year in real life, and I can do that without dealing with an insurance company, an insurance contract that's complicated. and just go out and buy boring old treasury bonds in today's world, yielding 2%, 2.5%, and 3%, closer to 3% in the 10-year, which again, I wouldn't buy the 10-year, but that's what you're up against. So don't let these financial products with these complicated formulas and lots of sales pitches steer you in the wrong direction. And as you can tell, I am not a big fan of these at all. Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.